haven't seen Bank of Canada prime rate change within the last 7 years. So yesterday the announcement was made in the morning that the Bank of Canada decided to increase bank prime by a quarter. Given the increase, yesterday obviously we've had an influx of clients and just the overall consumers in the area contacting our office. A couple of the points that the economists have indicated to us for the reason for the increase is a couple of them are the inflation rate. So the inflation rate has been is now currently at its lowest that it has been since 1999. Our dollar is at the strongest that it's been in the last 10 months, as well as the unemployment number. So employment has risen and created about 45,000 jobs from the report at the end of June. So with those factors and with the strong dollar as well too, is part of the reason why the bank prime rate had rose by 0.25%. In regards to the housing market as well too, we've seen some stabilization across the country on the housing market from the east to the west. With some of the mortgage rule implementations that have been provided this year, that the government has put into place, has slowed down a really, really overheated market over the last 9 months. And because of that, the government felt it was time to start increasing bank prime. We've had rumors in the past over the last 2 years that they were going to increase it by a quarter, but we didn't see that. And the result of it being is a lot of these other economic elements weren't at the point where we're seeing them today. So the forecast is mixed with some of the economists right now. So we're still gathering a lot of information to come up with a more concrete answer for our clients. But the overall consensus is that we're probably looking at bank prime, looking at it going to increase potentially another quarter by the end of 2018. I think the government's going to see how, with this 0.25%, how it plays out in the housing market. There is some rumors of our OSFI, which is our regulatory body for financial institutions, looking to implement some more mortgage rule changes come September. And with those mortgage rule changes, we'd be looking at the stress test that was implemented last year in 2016 for high ratio mortgages. So clients that are putting down less than 20% have to qualify at what they call the benchmark rate, which is typically 2% higher than where interest rates are. The rate is set at 4.64 currently. So it did take a lot of people out of purchasing homes this year. And with the rising values as well too, we've historically never seen them increase to 32% in the Kitchener-Waterloo area over the last 12 months. So that also declined our first-time home buyers getting into the market this year. So with that rule change, that helped soften the market, which is what the government wanted. And now they're looking to implement another stress test rule in September for clients that are qualifying to purchase with non-insurable mortgages. So what that means is that for clients that are putting down 20% or more, will have to qualify at a 2% higher rate than what their contract rate is. So to put that in simpler terms for the client is if the current 5-year fixed rate right now is 2.89%, they would have to qualify at 4.89% for the overall approval for the mortgage. They would still get that interest rate of 2.89%, but it gives the lender confidence that the client can be able to afford if interest rates go up in 5 years from now on a 5-year fixed term. So that hasn't been put into place yet, but the government is looking to implement that policy, for the last quarter of this year. And so that will also soften the market as well too. One of the big effects right now that is concerning on the Canadian economy is the household debt to income ratio. There are stats that came out yesterday that indicated that in Canada we're at the highest that we've ever been on household debt per family. 48% is what the indication came back at on the report yesterday. And to put that in comparison to the global economy, we're looking at Australia being number 2, which is 18%, and we're looking at the US, which is 8%. So if the Canadian economy is at 48% for household debt, that's very concerning. And so the government is looking to soften the housing market so that people are not over indebted in regards to purchasing or acquiring more investment properties, to see if that helps bring down that household debt to ratio income as well too. My personal feel on that is that that's not what the issue is. It's more unsecured debt. That's the problem. And we have yet to see any type of decreases on credit card interest rates or lines of credit interest rates as well too. So until I think truly that those issues are resolved, and there's a solution to the unsecured debt that the families have per family, per household in Canada, that factor of our percentage in Canada will not decrease. So time will tell. We'll see how the economy handles the changes. 0.25% really in the whole scheme of 7 years is not a lot. And considering where a lot of our clients and consumers with their variable rate mortgage and discounting, your rate is still very, very good, considering where fixed rates are. And typically in a variable, you will always be able to have more of your payment go towards principal. Your overall balance at the end of your term will be better than on a fixed rate as well too. And that's with the anticipation of that fluctuation of bank prime going up and down. So my recommendation at our office as well too is not to lock in right now. Take advantage of the variable. You're still in great interest rates on the variable. 0.25% is not a huge increase to make the recommendation to lock into fixed rates right now. And we'll obviously be monitoring this very, very closely. And for any of our clients as well too, we will be sending out our monthly newsletters and informing you as well too when we do feel at some point that we will think that there will be a time where to lock into interest rates right now. So everyone needs to hang tight, and let's see with these rule changes what happen. We still have a very strong economy, and the housing market, even with all the rule changes, is still really, really busy. We've had a great summer, and there's a lot of people that are still buying and selling, and we're still seeing that. We're just not seeing that chaotic housing market that we've had from November of last year till I'd say about May of this year. That has leveled off, and people now are able to put in more conditions when they're putting in offers, such as financing and home inspection again, which is a healthy market. And that's really what we want. We want to make sure that people are able to afford home ownership, that they're able to go in with the right precautions, so that when they do get their financing and get their home, that they are assured and not going to have issues on that house going forward as well.